Most Canadians think RRSPs are simple. Put money in. Save tax. Retire rich. But in 2026, that belief is exactly how people lose thousands of dollars without ever realizing it. In the next few minutes, you'll learn how RRSPs actually work in 2026, the biggest mistake people keep repeating, and the strategy high-income Canadians quietly use to turn RRSPs into a tax advantage instead of a tax trap. And stay until the end, because there's one RRSP rule that makes the always max it out advice completely wrong for a lot of people in 2026. First, let's clear up the biggest misunderstanding. An RRSP is not an investment. It's a tax shelter. Your RRSP doesn't magically grow money. What it does is change when the government takes its share. When you contribute to an RRSP, the CRA agrees to wait. You don't pay tax today. You pay tax later, when you take the money out. That delay is the entire benefit. Here's how that helps in real life. Let's say you earn $100,000 in 2026. You contribute $15,000 to your RRSP. Now, for tax purposes, it's like you earned $85,000. That could save you thousands in tax this year. But, this is critical, you're not avoiding tax forever. You're betting that when you withdraw this money later, your income and tax rate will be lower than it is today. And this is where most people get it wrong. The biggest RRSP mistake in 2026 is contributing without a long-term tax plan. People are told, just max out your RRSP every year. But that advice ignores one thing, your tax bracket. If you're in a low tax bracket today, but a higher one later, RRSPs can backfire. You save 20% going in, but paid 30% coming out. That's not tax efficiency. That's a silent loss. Now let's talk rules. In 2026, RRSP contribution room is still based on your earned income, up to the government-set annual maximum. But here's the powerful part most people ignore. Unused RRSP room never expires. If you don't use it this year, it rolls forward. This means you don't need to rush into RRSP contributions when your income is low. You can wait. Build room. And use it strategically when your income spikes. RRSP room equals stored tax leverage. So what about RRSPs versus TFSAs in 2026? Here's the honest answer. If your tax rate will be lower later, RRSP usually wins. If your tax rate will be higher later, TFSA usually wins. But for many Canadians, the best strategy is both. TFSAs give you tax-free growth forever. RRSPs give you tax-optimized timing. They do different jobs. Here's where things get interesting. In 2026, you're allowed to contribute to your RRSP, but delay claiming the deduction. Yes, that's legal. This lets you lock in contribution room now, but save the tax deduction for a year when your income is much higher. This is how professionals, business owners, and late career earners maximize RRSP value. If this breakdown is helping, hit like. It tells YouTube to show this to more Canadians trying to build real financial security. When you withdraw from your RRSP, the money is taxed as income. And eventually, your RRSP converts into a RRIF, which forces minimum withdrawals. That sounds scary, until you realize something. Most retirees earn less than they did during their working years. That's when RRSP math finally works in your favor. So here's the real truth about RRSPs in 2026. They're powerful, but only if you use them intentionally. RRSPs aren't about getting rich. They're about keeping more of what you earn. And the biggest mistake isn't doing nothing. It's doing the right thing at the wrong time. That rule I mentioned at the start, the best year to use your RRSP is often not the year everyone tells you to. If you have learned something today new, guys, please like this video. Also share it with your friends and family, and don't forget to subscribe for more informative videos like this. Thanks, bye.